M. Solomon here, your accountant, your auditor, mortgage auditor. 30 years of secondary experience, banking experience, exclusive to the mortgage industry, non-agency, whole loan sales, warehousing, sub-servicing. We've done it all. I've done it all. I can tell you everything I'm sharing with you is from hindsight, is from personal experience. So glad you could join us. Special thanks to Corporate Music for the wonderful introduction. And of course, reminder, we are not attorneys, we're accountants, we're auditors. We'd love to audit your file, and we would love to work with you and your attorney, or you if you're working pro se, pro per. But we're not attorneys. Only an attorney can offer your legal advice and legal rights and property. So let's get going. Today we're talking about an actual case, file number 206, CA009109. It's a case that we're alleging there's a direct investment by cancellation of debt, the conversion into qualified expenses treated as ordinary income, and that's taxed on tax form 1099A. If you've already gone through foreclosure and you're curious as to what happened to you, this is a great presentation with an actual case. And if you haven't received a 1099A yet, you got to act as if you will, because they are taxable and you will receive one post-sale. Is that clear? I hope so. Let's get going. Alrighty, let's take a look. Auditor analysis, actual case file. I think you may have seen this file before. I'm using it again because of the status of the case, new discovery, and it also is a boilerplate, I think, for what we're trying to do. In every case, we tend to see the same pattern over and over and over again. So this is the most convenient way of us showing you, what exactly is happening. What exactly is happening is this. We start with the note amount. 586.3. Had to get my microphone situated there. And we had a WAC, weighted average coupon. WAC is weighted average coupon, 5.408. Here's your Y2K. Multiply the note amount times the weighted average coupon, and you get a number 31705.81. Wait a minute, that's not a number, that's a date. That's your conversion of dates and numbers into dates used to confuse, and profit. Anyway, the gain on sale is 10, 20, 86. And that really equals 31,705. But if you add 586.3 in that date, look what you get. That's our outstanding balance, loan sold. That's what the loan sold for. We believe on 2/1/10, February 1st, 2010. Loan sold for 618,00581. You still with me? We're going to now jump to the payoff demand, which I believe was issued in September 7th, 2019. If you subtract the loan sold, which we calculated from these numbers here that were provided to us, and this 618 is the outstanding balance shown on the SPS servicing statement monthly, still to this date, long after the foreclosure alleged sale. If we subtract the payoff demand, which was issued by SPS on 9/7/2019, from the amount loans sold or their outstanding balance, you get 295,350.53. Could it be any more accurate? 33.5% federal withholding. That's 33.5% federal withholding. So if I subtract the payoff demand from the amount, which was the outstanding balance since SPS has gotten involved, the servicer, you come up with exactly 33.5%, which is your federal withholding. That means that the consumer should be receiving a 1099 for that amount right there, 618,00581. And guess what I'm showing? In hand, 1099, 618,00581. This, folks, is a contrivance. This is the treatment of a loan sold and the loan's value. If you add back all the accrual from the time the borrower stopped making payments, and they calculate that as federal withholding, somebody's going to pay someone's taxes, give them a 1099 for the net amount, pay their taxes, and steal a home for 295,350. That home's probably worth about $800,000. So what we're talking about are qualified expenses. The 881,650.53 would be the canceled debt, which is a qualified expense, a write-down. You got your federal withholding. Subtract that, and you come back down with the net operating income, which would be the note amount, and that's what was canceled, the original note amount. So what I can now do here, and I don't know if this is too much for you, if you're still trying to digest all this, we should probably take a break or summarize it one more time. But what I want to go over with you next is how they had a second transaction behind this, and these are these numbers right here, and how that second transaction was discovered, and how it's acting as a derivative of this transaction right here. Let's keep going. So in essence, this is what we are trying to say. This is what I think is so important to understand. It has to do with the post-sale reporting of the tax form 1099 C and A. Most generally and most often we're going to see the 1099-A being issued post foreclosure sale. And what we want you to do is consider attacking that, or have your attorney attack that in advance of the sale, in advance of the event, which triggers a 1099 taxpayer form for the expense allocated to the income received by you, which I believe was credited back for the write-down of the underlying third-party debt that had nothing to do with you. It was not your liability. Recall, the borrowers are a payee for COD income. Do you see the word fraud anywhere? Do you see the word collective, collaborating, fraud period? No. It's a claim, and the claim is by a borrower who was converted to a payee for cancellation of debt by involuntary conversion income. It was expense disqualified. Just for this, the purpose or the intent right here is that you understand qualified falls under a generous tax loophole that they're taking advantage of. So by canceling the debt at their election to cancel the mortgage, they get to expense it, and that's a tax loophole. It's a tax write-off. It's credited to you, the payee, as ordinary. That's another term you want to get used to. Ordinary would be taxable as federal, subject to federal withholding taxes. So it's expense disqualified, credited to you, the payee, as ordinary. This makes the borrower the investor for the amount paid on the tax form 1099. You're buying back your loan on behalf of the lender as the seller who's bankrupt, gone, and has been a long time away from from having anything to do with this transaction. So what you might want to also consider is how to bring that claim. Ask your attorney. Claims should be brought for proper characterizing of the subject transaction as a constructive liquidation of partnership assets that were the liabilities of the officers and directors of the bank foreclosing. Got that? Good. So from here, it goes from interesting to perverse. You recall from the previous screen, we had qualified expenses of $881, $650, $53. I call it qualified expenses. That would be your payoff demand. We subtracted the note amount, which I call net operating income, for a 1099, and the difference was your federal withholding. That came out to 33.5% on the mark, mark to market. What's really interesting is we then converted. We then had to come up with a annual installment amount. That annual installment amount was $62,496. We got that from multiplying 31 times 2016. What in tarnations? Just trust me on this. 31 times 2016 gave us an installment of $62,496, and we capitalized that at a factor of 0.0091. Say again. That's right, 0.0091. Where'd you get that from? I'll show you in a moment. Talking to myself. Anyway, annual installment $62,496 capitalized by 0091 came out to $6,867,692.31. This is a derivative of this bigger number. So our capitalized value we're dealing with, concealed from the consumer, concealed from the court, concealed from probably the servicer too, is $6,867,692.31, capped at 0.0091. What's interesting is we used 9.89 years for installments, installment sale method of accounting. And the reason we used that, I'll tell you in a moment, is that if you take the 62,496, 9.89, it gave you derivatives of 618,093.81. That's not the 618,00981 we had on the previous page, but it's damn close. And why is it close? Because the difference between that and the previous page for the outstanding balance, which is what the servicer is showing every month for the last 5, 6, 8, 12 years, 618,005.1. The difference is 88. 88 stands for a per diem or cost per share, whichever one you want to use. Anyway, installment 62,496 capitalized at 0091. That's 6.867 million. That came to 9.989 installments for 618,093.81. That's just 88 off the mark of 618,005.81. That indicates an insider, beg your pardon, an insider code for price per share or earnings per share, or what you would call a per diem. Only an insider would have knowledge of this, but the outstanding balance, which the server is showing, 618,005.81, was capped again at 9%. And that 9% brings us back to 6.867,692.31. You see where we have a linked transaction here? The 9.89 term came from 9% divided by 0.0091 equals a 9.89 term. It's insider code, algorithms. So the 9% is a derivative, 9% is a derivative of the 0.0091, or that equals one installment per annum until you get to 9%. You get it? Because 618,00581, our outstanding balance, capped at 9% equals 6,867,692. These are all linked transactions. You understand? Linked transactions. Now, where did we get where did we get this analysis from, or where did we get these numbers from? Because the only real number we had was 618,00581 from the statement or the previous page. Where did all the rest of this come from? I'll show you. And here's the summary. All these numbers, they came from none other than our case number. That's a court case number, 2016-31-009109. That's a court case number. Without that, I'd never be able to put this computation together. You see the 2016 times 31, that equaled the installment right there, 62,496. Hopefully you can see that. And that installment capitalized at 0.0091 equal to capitalized value. See that cap value 6.867 is factored at 9.9091. That came from a case number. And if you take the capitalized value, that's 6.867 million, and factor it by 9%, it gives you the outstanding balance. I beg your pardon, with an $88 of it, which gives me the per diem, which is also an insider track. So take the now 0.0091 factoring or cap rate and divide it by 9%, or the 9% divided by the 0.0091 makes this a derivative. That gives you 9.89 installments. These are linked transactions, are all related, and somebody is cheating right here by incorporating the computation, or how the deal is valued based on a case number, a court case number. Sacrilegious, unheard of. I ran this in a couple of posts with attorneys, and they were laughing, saying it's impossible. No way, I don't buy it. Well, you know, hey, I'm sorry, counsel, but numbers don't lie. I'm going to say it again, numbers don't lie. Who made that quote famous? Mark Twain? I don't know. I think it was Mark Twain. Numbers may not lie. People do, but numbers don't lie. This is all provided to us on the case number, which means something is going on that does not meet the eye, or goes beyond recognition of a sane auditor, at least an accountant. So all of these numbers appear to be linked, and they're all contrived. The economies of scale say 6.867 million on a $618,000 balance, or a 881,000 expense 1099. Economies of scale say I'm going to foreclose on you come hell or high water because I want my 6.867 million. That in turn should provide the borrower with a home, if the borrower states a claim. I think the borrower is entitled to a home, and they're entitled to the 6.867 million. But this is a direct investment. You cannot do a direct investment. Why? Because in a direct investment, the note canceled. It ceased to exist, and the property is no longer a secured property. The terms and conditions for the note and the deed in the cancellation of debt, voluntary conversion, the terms and conditions are extinguished with the note and the instrument itself, and the deed is used to transfer title and makes it a trust asset. The trust asset is being sold back to you through the trustee, who's concealed by a nominee. Nominee is always a seller, and you're the one who's repurchasing the mortgage, and that mortgage is in exchange for your title, which means you're getting a 1099. It's one big contrivance, but I don't believe you want to go out doing a lot of saber rattling, yelling, screaming fraud. I think you want to just state a claim, and that claim is, I am the party who repurchased my own loan. It's a direct investment. I am the investor in my own loan, and that is for the acquisition of my title. I'm not going to abandon it, as the 1099A says. You're going to acquire, but you're not going to abandon. How do you like that? Sound good? All right. So I don't know if anyone out there is old enough to remember the late 60s hit. I don't remember the name of the song, to tell you the truth, but the words, of course, went something like this. Oh, the games people play now, every night and every day now, never meaning what they say now, never saying what they mean, and they while away the hours in their ivory towers. Da-da-da-da-da. It's so apropos to what we're looking at here. But I'm not going to jump on the fraud wagon yet. What I'm saying here is that your claims should cite the proper characterizing of transactions under a trustee and constructive liquidation. Claims cite the proper characterization of transaction under a trustee's constructive liquidation. We're saying if the payoff statement is linked to the outstanding principal balance, that should come out on a 1099. The lender is the seller, and the seller's gain on sale is added to the note amount. That's your outstanding balance. A direct investment means that the note was canceled and that the deed transferred title. That set up what we call a installment sale, which is treated as seller carry back financing, where the trustee is the seller, concealed by a nominee, selling the property back to you. What they're really selling to you is the entire transaction for a zero balance. You are exercising the repurchase on behalf of the lender who sold the loan to the investor. Consumers repurchase back the lender's loan sold to the investor. I just said that. The transaction is for federal withholding, and the payee is entitled, you're a payee, you're entitled to repurchase back your home for the tax balance outstanding. Now, two things I want to say, that if your tax balance seems a little bit unjust, that why should you pay maybe $200,000 or $300,000 to buy back a $800,000 home? Well, think about that. Even $700,000. Why would you pay $150,000 or $200,000 to buy it back? Would you pay off if you asked for a payoff demand and that payoff demand was for $250,000 and your home's worth $650,000? If your payoff demand is only 20 to 25, 30, 35, as high as 33% of the payoff demand, would you pay that? I don't know why you wouldn't. But the thing is, and maybe I'll do this in another presentation, the amount of the federal withholding that we're talking about due to the IRS for these tax sales, these are tax sales by the IRS, for cancellation of debt and voluntary conversion, the amount of tax that is being charged is or appears to be the amount that the borrower did pay in from the time they were the loan first closed through the date they were told to stop making payments. I got a real problem with the definition by the IRS for the cancellation of debt. It says where a lender elects to cancel its debt. Well, it doesn't take a rocket scientist to figure out if you're secured by a lien that you can cancel your debt, convert that into rent, take a write-off, and then you get a house for free. I mean, cancellation of debt by election is for credit cards, okay, people. It's not for a car paper. You're not going to elect to cancel the debt and walk away. You can't cancel the debt without you've got the repossession of the car. In this case, you got a foreclosure. So to elect to cancel the debt, it's not an election. It shouldn't be an election because the lender is secured by the security. But in the cancellation of debt, it follows the note, and all terms and conditions for those contracts go out the window. So you can see what they're doing with the cancellation of debt by involuntary conversion. You should look it up. You should see how much literature has been published on it, both legal and scholarly. And what's best about it is if the judge or the court wants to give you some, if you come under scrutiny with this, then you can rely on the not only the Mortgage Bankers Association, but the bar. The bar has published numerous articles on cancellation of debt and voluntary conversion, as well as the IRS. And this is something that should fall into the IRS jurisdiction. I'm not an attorney. Only an attorney can advise you of your rights and property. But if this falls into the IRS jurisdiction, then that would be something that should be heard in a federal court, not in your state court, where the state is acting as, the court's acting as an agent for the state, and the state's a tax gatherer for the IRS. So I'm asking you to consider claims should cite proper characterization of transactions under a trustee's constructive liquidation. Oh, the games people play now. Let me say thank you for tuning in. Again, I'm M. Solomon, accountant and auditor. You can reach me, text me, whatever you prefer, 202-270-2641. I can also be reached at secondarytradedesk@gmail.com. If you're going to, I will do a no-cost initial preview audit for you on your file. What you need to do is first request a current payoff statement. You got to have that payoff statement. You also got to request the issuer's 1099. Who's the issuer for the 1099? I need the name of the paying agent. Request the issuer's 1099 name as paying agent. Also request payee's estimated income year to date. That's you. What's your 1099 going to show? You want to know what the payee's estimated income year to date is. They have to tell you. If they don't, it needs to be documented. Send us your most recent monthly statement from the servicer. Many of you are being serviced long after it went into foreclosure, which is just mind-boggling. You don't service a loan after 60 or 90 days. It gets turned over to a vulture and it gets liquidated. But send us a copy of your security instrument if you have it. Not important. I'd like to see the security instrument, the deed of trust or the mortgage. And send us, of course, any correspondence from your servicer. Once again, this is M. Solomon, and I've enjoyed this, and if you have any questions, feel free to call me. Don't be afraid. And if you want to leave a comment, tell us a little bit about what you're going through right now and who's servicing your loan and how long you've been in foreclosure. Leave a comment. It's not important for YouTube hits. I'm not about that. but we would appreciate your comments. It means a lot to us. I'm mostly available. We work about 23 and a half hours a day. No, maybe more, maybe less. I don't know. But again, M. Solomon, you can reach me at 202-270-2641 and secondary trade desk at gmail.com. Y'all take care.